Chapter 7, Sarbanes-Oxley, which is also known as SOX, internal controls, and cash. Sarbanes-Oxley emphasizes the importance of effective internal controls and applies only to companies whose stock is traded on public exchanges. So think of like big corporate companies. Internal control is defined as the procedures and processes used by a company to safeguard their assets, process information accurately, and ensure compliance with laws and regulations. Sarbanes-Oxley requires companies to maintain effective internal controls over the recording of transactions and the preparing of financial statements. Sarbanes-Oxley also requires companies and their independent accountants to report on the effectiveness of the company's internal controls, how well they're working, and these reports are required to be filed with the company's annual 10-K report with the SEC or Securities Exchange Commission. The objectives of internal control are to provide reasonable assurance that assets are safeguarded and used for business purposes, business information is accurate, and employees and managers comply with laws and regulations. A serious concern of internal control is preventing employee fraud. Employee fraud is the intentional act of deceiving an employer for personal gain. One example could be maybe not necessarily inaccurately recording your time on your timesheet, but it's intentionally done. So you know that you left at 4 one day when you were supposed to leave at 5, but you still put 5 on there. Stuff like that, and there can be some, more. I guess there can be other types of employee fraud as well. I mean, it could even be, financial, where you could be intentionally putting money in a different account, stuff like that. So internal controls are set up to really protect the company, and it also protects you, because a lot of times knowing that there are controls in place to, going back to the time card thing, if you know that someone's checking your time, you are less likely to inaccurately report your time because you're scared you might get caught. So it kind of protects you as well. The three internal control objectives can be achieved by applying the 5 elements of internal control. The 5 elements are your control environment, risk assessment, control procedures, monitoring, and information and communication. The control environment is the overall attitude of management and employees about the importance of controls. When you think of cash includes, it not only includes money, like physical paper, dollar bills, and coins, it also includes checks. Checks are considered cash, and money orders are also considered cash. Money on deposit with a bank account or other financial institution that is available for withdrawal is also considered cash. And cash is an asset that is most likely to be stolen or used improperly in a business. To protect cash from theft and misuse, a business must control cash from the time it's received until it's deposited in a bank. An important control to protect cash received, if you're thinking of an over-the-counter sales transaction, would be a cash register. A salesperson may make errors in making change for customers or when bringing up cash sales. If there is a cash shortage, the cash short and over account is debited for the shortage. If there is a cash overage, the cash short and over account is credited for the overage. So just make a note of what you would do if you have a shortage, if you debit or credit, because I know you're going to see something like that later. This is slide 10. And then at the end of the accounting period, a debit balance in cash short and over is included in your miscellaneous expense on the income statement. And let's see what the last little bit of this says, because it is cut off, so give me just a second. Okay, and then alternatively, a credit balance is included in the other income section of the income statement. And when if you do print this out, or if you save it to your computer, you'll be able to see this whole slide. It's just making it really big over here. Yeah, I can't adjust it. Cash received in the mail or EFT. So cash is received in the mail when customers pay their bills. This cash is usually in the form of checks and money orders. Most companies design their invoices so that customers return a portion of the invoice called a Remittance Advice with their payment. This document helps to control cash received in the mail. So when you get a bill, like a cell phone bill, at the bottom of the bill, you may have a little voucher type piece that you can tear off and separate and send back in with your payment, which most everybody's EFT now, which is electronic. But if you do send in a payment via check, you can send that little remittance form in with it so that they have all your information. And then cash may also be received from customers through electronic funds transfers. For example, customers may authorize automatic electronic transfers from their checking accounts to pay monthly bills for items such as their cell phone, their internet, and electric services. The control of cash payments should provide reasonable assurance that payments are made for only authorized transactions and cash is used effectively and efficiently. A voucher system is a set of procedures for authorizing and recording liabilities and cash payments. A voucher is any document that serves as proof of authority to pay cash or issue an electronic funds transfer. And for the purchase of goods, a voucher is supported by the supplier's invoice, a purchase order, and a receiving report. Cash can also be paid by electronic funds transfer, also known as EFT systems. Banks usually maintain a record of all checking account transactions. A summary of all transactions, called a bank statement, is mailed usually each month to the company, which is also known as the depositor, or they're also made available online. The company's checking account balance in the bank records is a liability. Thus, in the bank records, the company's account will have a credit balance. Because the bank statement is prepared from the bank's point of view, a credit memo entry on the bank statement indicates an increase or a credit to the company's account. Likewise, a debit memo entry on the bank statement indicates a decrease or a debit in the company's account. A bank makes credit entries. They issue credit memos for deposits made by electronic funds transfers, collection of notes receivable for the company, proceeds for a loan that's made to the company by the bank, interest earned on the company's account, and if there's any corrections or bank errors. And I have seen these where a check may be entered incorrectly by the bank, so everyone makes mistakes.
What is their internal controls for that?
That's when you contact the bank. But that's why we have people that check these things. There's your controls.
That happened to other people. That even happened to my mom once, like a long time ago. She just got a large sum of money put on her account. I don't know if that ever happens to me. I don't know what I'll do. I don't think I'll call it.
I'm not going to say anything, no. No, somebody normally finds it. Like, if it's not the bank, then it's the customer that it's going to, or it's the customer that it came from.
Mm-hmm.
Somebody normally always finds it. It just, sometimes it's a month or two down the road, but it's normally found in the reconciliation process, which one of those three should be performing a reconciliation.
Somebody got to be checked on.
Yeah. A bank statement. So the bank makes debit entries, or they issue debit memos for payments that are made by electronic funds transfers, service charges, customer checks returned for insufficient funds, and a correction of bank errors. So, and you see some of these on both slides, and that's just like correction of bank errors. The error can be that you were paid too much or you were paid not enough. So that's why you could see a credit entry or a debit entry. It just depends on the type of error that it was. The following types of credit or debit memo entries are found on a bank statement. So you have an EC, which is an error correction, and this is used to correct a bank error. NSF is not sufficient funds, meaning that there weren't the funds in the account to cash the check. A service charge, you may get these monthly. Some accounts have a monthly service charge fee. ACH, automated clearinghouse entry. This is something that's used for electronic funds transfer when you're paying things just electronically. And then MS for miscellaneous. And these are miscellaneous items such as collection of a note receivable on behalf of the company or receipt of a loan by the company from the bank. Just things that aren't very common would fall into that miscellaneous MS category. A bank reconciliation is an analysis of the items and amounts that result in the cash balance reported in the bank statement to differ from the balance of the cash account in the ledger. So, when we're doing a bank reconciliation, we are looking at what's in the bank, what do we have in, if you have like, say, Wells Fargo or Bank of America. So you have a Bank of America account, you're looking at what is in your Bank of America account, and you're comparing it to, if it's personal, you're comparing it to your personal bank book where you record all your transactions, if you do that, or you're comparing it to the transactions that that you have actually placed. That you went and got gas from Pit Stop and it was this amount of money, but then you may see something, a charge on there that you don't know about. And during the reconciliation process, this is how you find, I want to say probably the most common thing that I've seen personally is like subscriptions, things that you don't even really know you're signing up for, and then you just happen to look at your statement one day and you notice, oh, okay, I'm getting charged this for this and this for that, and I don't remember signing up for that. We have a car wash pass, and so It's a monthly pass to a car wash near where we live.
Like a mystery one.
Well, and so I paid for the car wash pass with my bank account, and then my husband also paid for my car wash pass with his bank account.
So you guys are paying.
So we're both paying for the same car to go through the car wash, and I'm like, we need to figure out how to fix this. But we never would have noticed that, especially considering, like he has his account, I have mine, and just I don't even remember how it came up, but somehow we realized that, oh, he made a comment that both car washes came out of his account, and that was his truck and my car. I was like, I'm paying for my car. So now we have to figure out how to fix that.
Wow.
But we never would have found that if, we hadn't had seen those transactions are coming out of our account through this reconciliation process. So it helps you can find, and also, I mean, there's like just little things where maybe like a $2 fee here every month. Like, it's crazy the types of little things that you go and buy something online, and then you end up getting charged like a monthly fee for just anything. So being able to find those in the reconciliation process, and if you don't want them, you can cancel them. The adjusted cash balance determined in the bank reconciliation is reported on the balance sheet. So if you do have to make an adjustment, you are going to report that on your balance sheet, and you'd make an adjustment if anything was incorrect. So here we see an example of a bank reconciliation. We have our cash balance. We have our cash balance according to the bank, and then we're going to add in any debits to cash that are not on the bank statement. And you can see these in a company. Most businesses do still write checks. So when you write a check, let's say it's February 27th or February 26th, and we're writing a check and we're sending it to pay for some bills that we owe. Well, we wrote the check on the 27th. It's going to show up on our ledger, our company ledger, on the 27th. But the more than likely the customer is not going to receive that and deposit it by the 28th. So on February 27th, we wrote a check for $100. So on our ledger, which is internal, our books, we're going to show that we don't have that $100 because we wrote this check, it came off of our ledger. But when we look at our bank account with Bank of America is going to still show that $100 is in our account. Because this check, even though it's already came out of our ledger on the 27th, the bank doesn't know that we wrote that check because it hasn't been deposited or cashed or anything. So then so that's the 27th. So then we'll say that was February. So then on March 1st, let's say that the customer finally cashed the check. So the customer got it and now they cashed it. Well, now on March 1st, both Bank of America and our ledger should both show that money is out of our account. But at some point, they're not going to show the same, because the amount of time that it takes for this check to go from our hands to our customers' hands and then to their bank, in that time period, our ledger and our bank account are going to be different. And it can also be the other way around as well. So if we receive checks, and different companies are different, but normally especially a small business, when they receive a check, the check goes to their accounting department, and their accounting department gets this customer's payment, and they go ahead and they enter the customer's payment for $200. So we received the check, we entered the customer's payment of $200 on our ledger, so our ledger is saying we have $200, but we haven't deposited that check at the bank yet. We've still got the check in hand. And then a few days, whenever we go to the bank to make our deposits, now we've put that $200 in the bank. So now our bank is going to show that we have that $200. So it can go both ways. So that's what they're saying here for this reconciliation process is you've got the cash balance according to the bank, and then you're going to add in any debits to cash that are not on the bank statement. So anything that's happened within your company but is not yet on the bank statement. And then you're going to deduct any credits to cash that are not on the bank statement. It's the same thing. So what you're trying to do is you're trying to get your ledger and your bank statement in your reconciliation kind of the same. And so this is going to give you your adjusted balance. So what you're going to do is you're going to add in your debits, deduct your credits, and this will tell you what your adjusted balance should be. And then when you're looking at the cash balance according to the company, you're going to do the same thing. You're going to add in your unrecorded bank credits, deduct out your unrecorded bank debits, and then that's going to give you your adjusted balance that's according to your company. These adjusted balances should both equal. So it is usually not practical for a business to write checks to pay small amounts for items such as postage, office supplies, or minor repairs. So it's desirable to control payments using a special cash fund, and a lot of companies use a fund called petty cash. And petty cash is normally cash on hand kept at the location, a small amount. I mean, it just depends on the company and how often they have to use stuff like that. They might have like a $500 petty cash fund or a $1,000 petty cash fund, and normally the main thing that I've seen these used for is, if you run out of office supplies and you have to go somewhere to get it, or some companies, they'll keep drinks or snacks on hand in the office, so they might send someone to Kroger or somewhere to get that type of stuff and just give them, $50 out of their petty cash account, send them to Kroger, they buy whatever they're supposed to buy, they come back, they return the change from the petty cash that they didn't use, and then the receipts, and then all of that is recorded in the petty cash fund. A petty cash fund is established by estimating the amount of payments needed from the fund during a period such as a week or a month. Again, this can vary. A check is then written and cashed for this amount so that they have cash on hand. And the money obtained from cashing the check is then given to an employee called the petty cash custodian, who disperses the money from the fund as needed. So what they're saying here is that there's a person that kind of like manages the petty cash fund. They call them a petty cash custodian. And this person basically keep a file or a book where you'll see they'll have like this ledger for petty cash, and they cashed a check for $500. So they have $500 in the petty cash account. And then when Joe comes to get money to go buy office supplies somewhere, they record the day. So we'll say January 15th, Joe got $50 to buy office supplies. And so then we have this, and then Joe goes to the store and he buys office supplies, and then when he comes back, he came back and he gave, he came back and he returned $10 and he purchased office supplies for $40. And everybody records this differently, so it's not going to be exactly the same. But this way they can keep track and they know that the balance in their petty cash account is correct. So they know that Joe took out $50, he returned $10, and he had $40 in supplies. So that is still going to give us our $500. But now in our petty cash account, we've got $500 minus $50 plus $10. So we've got $460 cash, and then we've got $40 in office supplies that we used out of our petty cash account. And then a lot of times, so we started with $500 because we feel like that's a good amount for our company to have on hand all the time. So if this gets really, really low, we'll make a withdrawal earlier than usual to refund this account. But let's just say we don't use our petty cash account anymore for the rest of January. So on January 31st, we still have $460 in our petty cash account. A lot of times companies will write a check to bring that account back to the $500 so that it's consistently got the $500 in it. The money obtained from cash in the check is given, so we talked about that, where it's given to the custodian. And then when a petty cash fund is replenished, when we put our money back in to replenish the account, the accounts debited are determining the summarizing the petty cash receipts, and then a check is written for this amount to pay petty cash, which is basically what I just said. So we're determining the amount that we used in petty cash, and then we're going to replenish the account. So that's what this 40 is. So we wrote a check for $40, cashed it to get the $40 cash to bring our account back up to 500, to replenish it to the 500. Companies often use other cash funds for special needs, such as payroll or travel expenses, and such funds are called special purpose funds. A company may temporarily have excess cash. This excess cash is normally invested in highly liquid investments in order to earn interest. These investments are called cash equivalents. And I don't know if you remember, but highly liquid investments, these are things that are, liquidity is how quickly something can be converted to cash. So a highly liquid investment is just an investment that can be quickly converted into cash. Banks may require that companies maintain minimum cash balances in their bank accounts, and such a balance is called a compensating balance, and it's normally disclosed in the notes to the financial statements. A compensating balance is often required by the bank as part of a loan agreement or line of credit. The ratio of cash to monthly cash expenses is useful for assessing how long a company can continue to operate without additional financing or generating positive cash flows from operations. The ratio of cash to monthly cash expenses is computed as follows, and you can see this clearly in your PowerPoint. So I apologize for this again. But to calculate the ratio of cash to monthly cash expenses, you are going to take the cash at the year end and divide that by your monthly cash expenses. And to find your monthly cash expenses, you're going to take the negative cash flow from operations and divide that by 12 months. So monthly cash expense You're going to find that by taking negative cash flow from operations divided by 12. And then once you found your monthly cash expense, then you can compute your ratio of cash to monthly cash expenses. And to compute that, you take cash as of year end divided by your monthly cash expenses. I'd probably write those down on a little like index card or something so that you have that easily accessible and you can kind of just go through those. So we're going to go through a couple of practice problems. I think there's like 10 or so. So for this one, we are trying to figure out how much was the beginning balance of the cash account. And it says, consider the following information taken from the cash account. Assume cash payments were 80% of collections. So they've given us our collections, they've given us our ending balance, but what we don't know is what the beginning balance was or our disbursements. And we're assuming that cash payments were 80% of collections.
So you find 80% of that 115.
So for this one, it's a two-part question. So first, what we need to do is figure out what our disbursements are. So it says, assume our cash payments were 80% of collections. And our cash payments, that's money going out, so that's going to be our disbursements. So 80% of collections, 80% of 115,375. Yep, is right. So 80% is this 92,300. Good job. And then, so now we've got the disbursements. So we know that our disbursements are that 92,000. I'm not going to write. I'm not going to try to write that there. It's down here. So then to find our beginning balance of our cash account, because that's what we're left with that we don't know, we're just going to add and subtract these to figure out what that beginning balance was. So you're going to work backwards to find the beginning balance. So we know that we ended at 80,000. So we have 80,275 as our ending balance. Disbursements, that's money that we took out of our account, so we're going to have to add that to get our beginning balance. So we're going to add back our disbursements, and then money that we collected during the period, we're going to have to take that out because we're trying to figure out what we had at the beginning. And it may even be easier for you to just put, just plug a date in. So just say, okay, this was the 1st, this was the 31st. And you can even plug dates in on these two if you want. You could say that we took all of our collections in on the 5th, and we did all of our disbursements on the 10th, and on the 31st, this is what we were left with. And so you're trying to figure out what you had on the 1st. So we're going to go, well, on the 31st, we had 80,000. And I'm just going to put 80 here because our numbers are there. So on the 31st, we had 80,000. We paid out disbursements on the 10th. So we're going to add those back because we're trying to figure out what we had at the beginning. So we're going to add back our disbursements of 92. And then we collected 115,000. So we're going to take those out. And then that's going to tell me that at the beginning, on the very 1st of the month this year, we had 57,000. You can do it however you want. That's just, sometimes for me, it was easier just to kind of like plug in numbers and give them dates. But however, whatever works best for you. And so we see down here, this is the formula. This is how they calculated everything. So this next problem, they're asking what the journal entry is that we're going to use to replenish the account for petty cash. So we have a $150 petty cash fund that has cash of $54 and receipts of $83. And they're asking us to create a journal entry to replenish the account.
Thank you so much.
So they're asking us.
Or not debit, but you need to credit them. Always get confused on that.
Yeah, debit and credit is confusing. So it is, you're going to debit. So when we kind of think back to this example over here, we needed that $40 to replenish our petty cash account and get it back to the 500. So the balance in the petty cash account is normally 500. We had spent, we'd spent $40 here. And so we replenished the account with $40 right here. So they're telling us we've got $150 is going to be that 500. All right, so this account normally has 150. And currently, there's $54 in it. And then we have receipts of 83, and the receipts are right here when we said we spent $40 on office supplies. That's our receipts for that one. So our receipts were $83. And so they're asking us the journal entry to replenish this account would include what? So,
And then we gotta put back $83. So
we have,
Cash short or short and over for $13.
yep. So, and the reason is we are missing some money. So, oh, you can't see that. Yeah, so we've got this $150 petty cash fund minus, we're going to take out what cash we still have on hand. So we're going to take out the $54. And then we have receipts showing that we did validly spend $83 from the account. So we're going to take that $83 out, but we're still short $13.
Yeah.
So so the journal entry to replenish the account, we're going to debit cash short and over for $13 to replenish our petty cash account.
And then I didn't notice that the 83 and 54 didn't add up to 150.
Yeah, like what? I don't get this. So Pilger Corporation has cash on hand at year end of $201,000 and a negative cash flow from operations of $144,000. What's the ratio of cash to monthly cash expenses?
This is the one where we gotta find the monthly, and then we gotta find the year.
That long one?
Yeah.
So just make sure you're taking notes. We'll go. So you take the negative cash flow from operations, and you divide that by something to find your monthly cash expense.
Your negative cash flow from operations.
Bottom line,
I'm sorry?
divided by the one,
That's correct. Yep. So divided by 12.
so first,
Yes, ma'am. So for the first half of the problem, you'll take your negative cash flow from operations and divide that by 12. And then and that'll give you your monthly cash expense.
And then you divide that by your year. Or that cash that year.
Yep.
$16.75 rounded.
Yep. So, so we found our monthly cash expenses by taking the negative cash flow from operations, which is 144,000, divided that by 12 months to give us 12,000. And then that gave us our monthly cash expense. So then to find the ratio of cash to monthly cash expenses, we're going to take our cash as of the year end, which they told us here is 201,000. We're going to divide that by the monthly cash expense of 12,000, and that's going to give us 16.8 months. And you might have to round, and if you round, just round, you know, up or down depending on what your decimal is. Yep. So this one, we're trying to find the amount of outstanding checks in their bank reconciliation. So minor company had checks outstanding totaling $19,200 on its April bank reconciliation. In May, minor company issued checks totaling $64,900. The May bank statement shows that $47,600 in checks cleared the bank in May. A check from one of minor company's customers of $300 was also returned and marked as an NSF. And the amount of outstanding checks on minor company's May bank reconciliation should be So I'm just going to kind of talk y'all through this. So when we think back, we can think back on this example. I erased half of it, but you know, we have our ledger and we had received some checks, but so we had the checks on our ledger, but they weren't in our bank account yet, or vice versa. We received some payments that we put on our ledger, but they hadn't hit our bank yet. And then in this example, they have that $300. So they received $300 as a payment. So they put $300 on their internal ledger, but then the bank, when the bank got the $300, it was an NSF. So the bank got it and they weren't able to put it in their account. So it never hit their account. So they still have this $300 over here that they need to take out because it was an insufficient fund check. So as of right now, just looking at that one scenario, their ledger is going to be overstated by $300. So they're going to have to take this off of their ledger. So it says the amount of outstanding checks on the May bank reconciliation equals our outstanding checks that appear on our April bank reconciliation, plus any checks that we issued in May, minus any checks that cleared in May. So we had checks outstanding of $19,000 in April. And then in May, we issued checks, meaning we wrote checks that totaled $64,000 in May. And then the May bank statement shows that $47,000 in checks cleared. So that means they came out of our bank account in May, and a check from one of our customers, $300 was returned. The amount, and then so the answer is 36,000. And what we're going to do is we're going to take checks outstanding of $19,200, and then we're going to add in the checks that we issued of 64,000, and we're only going to subtract out the ones that actually cleared. So we wrote $64,000 in checks, but only 47,000 of those checks cleared our bank. So we're gonna add back the checks that we wrote for 64,000, and then we're just gonna take out the ones that actually cleared our bank, which is the 47,000, and that's gonna give us the 36,000. The $300 is gonna be included in the $300. The reason that we're not separately taking that out is because it never cleared our bank, and we're looking at the ones that cleared our bank here. So anything that didn't clear our bank is really the difference of these two. Checks written minus checks cleared. So the $300 is captured right here. So that's why we did not put that individually in this calculation. So we had 19.2 outstanding. Issued checks. So we wrote checks for 64,000. And then 47 cleared, and that gave us 36,500. And they mentioned in here the $300 return to NSF, and that $300 return to NSF, that is something that did not clear. So that's included in the difference of these two. We issued these cleared, so the difference of the two is what did not clear. So that's why we're not looking at that 300. This next one, they're wanting us to calculate the adjusted cash balance per the books on May 31st. So it says Rogers Company gathered the following reconciling information in preparing its May bank reconciliation. Calculate the adjusted cash balance per the books on May 31st. So we have our cash balance per the books on May 31st at $5,400. Deposits in transit of $375. Notes receivable and interest collected by the bank of $650. Bank charges for check printing, $40. Outstanding checks, which are the checks that we've written but they have not been cashed by our vendors. Outstanding checks are $2,400, and then there's an NSF check for $140. We need to calculate the cash balance per the books.
So we would just add up all those transactions and take them away from that ending balance at the top at 5,400 to get the cash balance.
Mm-hmm. Yep.
Is that not coming out of the account during that time period?
You don't need those.
Yeah, that won't make sense.
So for this one, you're going to take the cash balance per the books of 5,400. You're going to add in the notes receivable and interest collected of $650. You're going to subtract out the bank charge, and you're going to you're going to subtract the NSF check. And that's going to give you $5,870. So that's how you'll calculate your adjusted cash balance per the books for the end of May. So the cash balance per the books plus any notes receivable and interest collected by the bank minus if you have any bank charges, and then minus if you have any NSF checks. And so for this one, we have 5,870. In the normal operation of business, you receive a check from a customer and deposit it into your checking account. With your bank statement, you are advised that this check is $775 and is an NSF. The bank also informs you that due to the amount of activity on your business account, the monthly service charge for this is $75. So during a bank reconciliation, you will do what when you're reconciling this? So you have, I'm sorry? So track both values according to the books. Because you've already recorded you've recorded this in your book, then you have to record this fee as well. So you'll subtract both of those. You added this in, but you didn't get it, like this $300. So you added this in, but you didn't get the money, so you're going to subtract that out. And that monthly service charge, you're going to have to subtract that as well because you got that fee. Good job. The type of account and normal balance of a petty cash account is asset debit, because cash is an asset account, and you increase it with a debit. The debit recorded in the journal to reimburse the petty cash fund is to what account? The debit that we record in the journal when we're reimbursing the petty cash fund.
Because it could be pictures to be like specific, right? But it's still cash.
So it's actually various accounts depending on how the petty cash was dispersed. So we can, like here, we used office supplies. Just it depends on what account we used it for. But that was good too. But yeah, it can be multiple accounts. So a $200 petty cash fund has cash of $20 and receipts of $177. The journal entry to replenish the account would include a credit to, so we have a $200 petty cash fund. We've got 200 cash in it and receipts of 177. Well, this one looks familiar. So for this one, we're looking at the entry to replenish the account. So it's kind of opposite of it's similar to the other one that we did, but different. And here's how. So we've got this $200. That's what our fund normally has. And we've only got $20 cash left in the account right now. So yes, we have these receipts here, and there is a difference of $3. But what they're asking us in this question is, so the question is slightly different. So here they're asking us, what do we need to do to replenish the account? So we've got $20. We had $200, and we've got $20 still in there, so we need to replenish it with 180. So the journal entry to replenish the account, we're going to credit cash for $80 for $180. So it's just the wording, just because you'll probably see questions similar to both of those on there somewhere. So just make sure the wording. But you would have been right if they were asking about the receipts. Good job. So that's all of our practice questions for this one.